It's Brian Preston, the Money Guy.
Tony has a question. He says, if my income is $65,000 and federal and state income tax rate is 27.07%, very specific, love it, should I contribute to Roth 401k or standard 401k? I currently do 7% standard and 1% Roth. Plus, I max out my Roth IRA. I'm 33 next month for more context, and I invest 30% of my gross income, which is great.
I mean, this is very specialized because he gave us. I mean, he basically wrote us a lot of variables there.
Can I repeat them back?
Yeah,
Is that okay?
yeah.
All right. So Tony has an income of $65,000 between state and federal. He's in the 27% tax bracket. He's 33 years old. He's trying to figure out, should he do Roth or should he do pre-tax? And he's saving 30% of his gross. So in order to be able to provide like specific advice, there's a few other questions we need to know. What are your goals, right? Like, what's the end game? What are you trying to move towards? When are you trying to retire? When are you trying to exit the workforce? And then what do your other accounts look like? What does your after-tax account look like? What do your current 401k accounts look like? What do your current Roth IRAs look like? How much do you have in those? Because really, when you're in that, what we call the gray zone between 25 to 30%, the answer to pre-tax or Roth kind of is fluid a little bit. So that's kind of a difficult one to answer without knowing the specifics. But I do think, Brian, it'd be valuable if it were below 25% or it were above 30%. It's a little bit easier, right? It's a little bit more cut and dry.
Yeah, people. I think we're unique in the content space because we actually give you some variables to think about so you can truly make decisions and see where that delta is to know, hey, this is what I should be doing and what I shouldn't be doing. And what Bo was just talking about, the boundaries. Below 25%, it's a no-brainer kind of to do Roth because, look, I think this is some pontification on what do we think tax rates are going to do in the long term. And we know the government has really got themselves in a pickle with a lot of obligations to the point that maybe the only way we're going to be able to pay for all this stuff is if we raise tax rates at some point. So it makes sense if you're under the assumption that, hey, there's a good chance in retirement my income will be lower because I'm no longer going to have all this earned income coming in. I'm going to be living off the portfolio. And we know the combination of the government's probably going to have to raise taxes at some point. Yeah, it's a no-brainer to say below 25% Roth. I think 25 to 30 is that gray zone we talk about, just because you are playing that game of what my taxes look like in retirement. Because it's not only just where tax rates, realize the state you live in, a lot of states really love retirees. So they give you huge tax incentives. They don't tax your Social Security. They won't tax your retirement assets up to a certain level. So there's a lot of things that will play into your taxation that really pushes that tax rate lower in retirement. So that's why we have the 25 to 30. But you just told us, I will say that this is something just that hit me. You're 33. And if you have a retirement that's past 55 years of age, you got a long time for compounding growth to work. And I really like that thought of tax-free compounding because a millionaire status in a retirement account that has no taxation on it, that just gets me tingly, where my hair even stands up on my arm. So I would take that. I'd let that kind of nudge. I don't know if I like that 7 and 1 because that's adding a complexity level. Why? I mean, why not go ahead? Because if you're making 65, I bet you're going to go beyond 27% in your taxes, both federal and state on your effective rate. Let's go ahead and get some of that Roth money working with that tax-free growth.
Yeah, we don't know what future tax rates are going to look like. That is a true statement. But we do know 0% will always be a pretty attractive tax rate. And so if you can compound that growth, and I know there's some guys who hang out in the chat every single week and they want to tell you about RMDs. When you get to 72, it's going to blow up. It's going to be, there's some truth in that. That is a thing that takes place. Well, if you have Roth assets building, you do kind of inoculate yourself from some of that. So I think if I were just gauging, I'm guessing it's leaning towards the Roth, assuming all the other variables line up.
And maybe I shouldn't bleed in, but RMD bombs, I hear about this. It's hard for a 33-year-old to know this is going to be a problem,
Absolutely.
and that is a good problem. We help clients navigate those RMD bombs when you're a prolific saver and you've built multiple 7 figures in retirement assets, and your distributions. There's a chance you're going to actually make more in retirement than you make, but that's That's the type of problem you hope for.
That's right. That's a good
so
problem
let's not mess up a 33-year-old worried about something like that when we're just trying to build that foundation to ensure they're actually going to win the game. That's a maximization strategy versus a building wealth strategy.
Love it.